Hi everybody, Alex Deploy here from Expert Forex, and in this video we're going to be looking at equity protection for Expert Forex robots. We have added settings that you can use to protect your equity. Now, many traders don't realize that trading success is actually based on two things: finding a good trading strategy and good risk management. Without good risk management, you can have the most fantastic strategy and blow your accounts over and over again. And in fact, most of the accounts that we've seen that have been blown are not because of a bad trading strategy, but because of very poor risk management. So I'm going to cover the settings that you can use to allow you to manage your equity. So equity protection allows traders to protect their accounts from large drawdowns. In general, that means closing negative trades before a certain barrier is reached. Now, for instance, prop traders, they have a 5% drawdown limit, and many prop traders like having an equity protection mechanism that will close all deals before the 5% drawdown is reached. That is what is referred to generally as equity protection. But then there's Alex Deploy's equity protection version, and my version says set your strategies up properly at the start in such a way that you will never have to close trades because you are in trouble. Now, that's slightly different from the previous definition, and that is what I'm saying is if you do your setup properly in the beginning, you won't need to close negative deals. So it is basically a battle between greed and the fear of missing out and sensible trading. People want to make nice profits, but they're not happy managing the risk that it takes. So I'm going to show you equity protection built into the Expert Forex robots so that you can see how you can protect your equity very, very well. And in fact, a lot of these concepts can be used for most robots, but I'm going to be focusing mainly on the profit retrieval robots because they trade without stops. Simple as that. They do not have stops. They rely on the profit retrieval process to be successful. So let's have a look at these factors that we're going to be looking at. Firstly, we're going to look at account sizing. We're going to look at lot sizing. We're going to look at currency exposure, gap sizing. We're going to look at increased gap sizing, and we're going to be looking at the skip function. These are all equity protection settings that we have built into our robots that will help you manage your equity. Now, before we start, we need to create a base case. In other words, a case that we can reference the settings to give you an idea of the impact of these particular equity protection settings. So the base case is a profit retrieval drawdown that has 12 levels. There are the levels, and basically at each level the lot sizing used to top up trades is 0.1. There it is all the way through. And the gap size, in other words, when a transaction goes negative, it will open another trade 20 pips from the first trade, and then if the price goes down another 20 pips, it will open another trade, and so on and so on. And that is why you then end up with 12 open trades, of each having 20 pip gaps from the previous one. So the gaps are 20 pips, and that means that the price can travel 240 pips to reach this status where your drawdown is 1,560, because the most recent top-up will only have a loss of 20 pips. The most recent top-up will only have a drawdown of $20 because 1 pip is a $1, and then we've calculated the total drawdown for all of the open trades. So this is our base case. This is what most people trade. They have a gap of that, lot size of that, and they have drawdowns of that should they reach 12 levels. So now we're going to say, how do we manage the risk? How do we get this drawdown to be much lower, or the drawdown percentage to be much lower. So let's have a look at the first answer. So the first answer is, hey, start with an account size that is appropriate to the risk that you're going to be trading. So in other words, if you were trading a $3,000 account and you incurred that kind of drawdown, that would be 52% of your account that you have drawn down. But if you used a $10,000 account, it would be 16%. And if you used a $20,000 account, it would be 8%. So which trader, I ask you, would be sleeping the best in the evenings? Would it be this trader that started with an account that's way too small for the risk that he's trading and has a 52% drawdown exposure? Or do you think it's this trader that has a $20,000 account and is only incurring an 8% drawdown? So drawdown is very, very relative to your capital that you're trading, and if you are trading undercapitalized accounts, you will be exposing yourself to amazing amount of risk. And this is where equity management comes in. If you don't want to expose yourself to excessive risk, very simple, just increase your account size. So that's the first equity management method that you can use. If you are scared of drawdowns, increase your account size. Okay, so now the next one, and this is a major one because this is the major cause of extreme frustration for Forex traders, because they use too larger lot sizing. So here in the base case, we've used 0.1 lot sizing for our 12 transactions. Here in this next example, I'm saying why not use 0.01, which is 10% of that one, and therefore your drawdown will go right down to 1.56. Now the first thing you're going to say, oh, but if I do that, my gains will go down. Exactly. That is what greed is all about. People that are too greedy will increase their lot sizing to a point where their risk becomes unrealistic. So rather trade low lots, make small profits, then trade large lots and blow your accounts. That's basically the choice you need to make. So here's a good example. Suddenly your drawdown is so much smaller, and look at that. On a $3,000 account, now you only have a drawdown of 5%. On a $10,000 account, you only have a 2% drawdown, and on a $20,000 account, you have a 1% drawdown, which is rounded, obviously. So lot sizing is where greed and the fear of losing out catches traders, and they want to squeeze as much profit out of every single deal and every single strategy, and that is where they get caught. It's a bit like the casinos. They know how to draw you in to take excessive risks, and that's exactly what lot sizing does. And that's why brokers give bonuses, because they know that clients are going to use lot sizing that is way bigger than they should. So there's number 2, lot sizing. So account sizing was number 1, lot sizing was the next equity protection setting. Then you have gap sizing. So again, our base case, there is our base case, and we say, so instead of using a gap of 20 that gives you protection for 240 pips, why not have a gap size of 40, which will give you also the same protection, 240 pips, but your drawdown, if you look at the drawdown numbers here, is almost half of what it was before. So there's a method number 3. Use gap sizing that is bigger, and it will reduce your risk of drawdown. Again, look at the numbers here. From on a $3,000 account, the drawdown is 28%. A $10,000 account, it's 8%, and $20,000 account, it is 4%. So that's method 3. Now the other way of increasing your gap sizing is by systematically increasing it. So for instance, in this example, the gap sizing is increased by 120%. So you start with 20, 120% of that is 24, 120% of 24 is 29, 120% of 29 is 35, and so on. So that's another way of increasing your gap sizing, doing it systematically as the trend continues. Again, it reduces your drawdowns dramatically from what it was before. You can see the percentages draw down there, and this method allows the price to move 7 levels down. In the previous example, it only moved down 6 levels. So there's your next equity protection setting, and the problem is traders do not use this to control their equity. No, they would rather turbocharge these settings to get the biggest gains and to expose their accounts to the biggest risks they possibly can. So my philosophy is start small, start with very, very conservative settings. Use these equity protection settings that have been provided in your EAs to control your equity. Let's move to the next one. The next one is the skip function. The skip function basically says skip some of the levels. Don't do anything for, let's say in this case, two levels, and then just continue after you've skipped 2 levels. And this is in fact exactly what happens here. Here's the normal case that we had. Here we've skipped 2 levels. Look at the dramatic change in drawdown, again from 52% to 38%, from 16% to 11%, from 8% to 16%. So the skips function is again an equity protection function that you can use to protect your equity, to lower the drawdown exposure that you have. Now, the trick here is to use all of these functions at the same time and therefore reduce your potential drawdown tremendously. Now, there is another one, which is the currency exposure one, and I see this happening all the time. So what a lot of traders would do is they'd use a $3,000 account and trade 4 currencies at the same time using that size account. That means they are exposing themselves to 4 times the risk that a single currency would have. And there you can see the drawdown, $6,000 if you're trading 4 currencies at the same time, or we're allowing 4 currencies to be traded at the same time. That's the potential risk you're exposing yourself to. And on a $3,000 account, obviously you're going to blow the account. On a $10,000 account, you're going to have a 62% drawdown, and on a $20,000 account, you can have a 30% drawdown. So reducing the number of currencies that you trade. So instead of trading 4, you just trade 1, such as in the base case, and that immediately reduces your drawdown exposure and gives you equity protection, because you are now reducing your exposure to excessive drawdowns. Now, there's another one that I need to show you, and that is the age of the account. So in our linked account service, here is a list of linked accounts, and you can see the ages of these linked accounts, and you can see the returns that have been generated by these linked accounts. More than doubled, almost doubled, and so on. There's one that's almost doubled six times, and that one's on its way to be doubling and doubling. So huge returns on these older accounts. So why are these accounts doing so well? And it is because although here are the account balances, it's 23,000, 24, years sums 68,000. Although they have these massive accounts, they are being traded as if they are $10,000 accounts. So the settings that are being used to trade these accounts are the settings that you would use for a $10,000 account. Now, that is equity management, because it reduces your risk tremendously and doesn't lower your potential of earning good returns all that much. You can keep it in line, but again, as I say, you are then exposing yourself to much higher risk, and your equity protection goes out the window. That people don't realize that this is what they're doing. When they're trading, they are destroying their equity protection. So please remember this formula. The good trading strategy has been resolved. The Liberty range of EAs, the wave trader and the RSI trader and the profit retriever, and now the expert Forex hedged EA, take care of the good trading strategy. They will be profitable anyway. Over time, they might not be profitable in a day, but over time, these will be profitable. So you don't have to worry about this side of the equation anymore. It is this side of the equation that is killing traders. They are using accounts that are too small. They are using lot sizing that is too big. They're not increasing their lot sizing. They're not doing any of those things that I've shown you in this video. And that is why accounts get blown. Not because they lack a good trading strategy. In fact, we have seen a few examples where the trading strategy was profitable. In other words, it had a positive gain, and yet margin calls were experienced because the risk management aspect was not adhered to. The lot sizing was too big, and that resulted in too much margin requirement, and a margin call happened in spite of positive results. Now please, this is one of the most important slides that you will ever see, and if you ever blow an account, you come back here and you say, was my risk management as good as it could have been? And there are, in 95% of the cases, you will find that this is where the problem is, not on that side. Now, I hope you've enjoyed this video, and I hope you've learned something about equity protection and how you can protect your equity by using conservative settings relating to lot sizing and currencies traded and all the items that I've mentioned in this video. I will provide links to any items relevant to this particular video in the description of the video, as well as in the commentary. Please remember that we've had well over a year's worth of experience of trading these accounts on our linked service, and we now know why certain traders are failing and why other traders are succeeding. And it mainly revolves around the equity protection measures that these traders are taking. So for me, Alex Deploy, cheerio.